Welcome to The Explainer. You know, in trading, there are gamblers, and then there are snipers. Today, we're talking all about the sniper, a model built on pure patience, absolute precision, and a very specific sequence of events that the pros follow almost religiously. We're going to break down that exact playbook step by step.
But first, let's just tackle the elephant in the room, right? A question that pretty much every trader asks themselves at some point. Why is being consistently profitable so incredibly hard for so many people? Well, the source material we're looking at today suggests it really just boils down to two things: your mindset and your method.
And this, right here, this really captures the two sides of that coin. On one side, you've got the typical retail trader. They're reactive, they're chasing price, they're totally driven by FOMO. Let's be honest, it's just gambling. But on the other side, you have the sniper. They're patient, they're precise, and they follow a very strict process. This entire model is built on that second mindset.
So here's our mission briefing for today. First, we're going to understand the trap that catches most traders. Then we'll map out the battlefield, learn how to spot the smart money signal, and pinpoint what's called the sniper's kill zone. Only then do we talk about execution and the ironclad mindset that makes the whole thing work.
All right, let's jump right in. The very first step is to just acknowledge the problem this whole model is designed to fix. That frustrating cycle of random entries, emotional decisions, and just plain inconsistent results that really traps most aspiring traders.
So now we get to the foundational work. Look, a sniper never ever takes a random shot. They survey the terrain first. And in trading, that means mapping the market structure before you even think about placing a trade.
The number one rule is to figure out your higher time frame bias. Are we in an uptrend or a downtrend on, say, the 4-hour or the 1-hour chart? This is your compass. Trying to trade against this dominant current is, as the source puts it, just gambling.
Okay, next up, within that trend, we use a really simple but incredibly powerful filter. You just divide your current trading range in half. The whole goal here is to stop you from buying at high prices or selling at low prices. You only hunt for sells in the premium zone, that top half, and you only look for buys in the discount zone, the bottom half. Simple as that.
So why does price even move? Well, it's searching for orders. And these huge pools of orders, especially stop losses, they act like giant magnets for institutional algorithms. I mean, think about it. Where does everyone put their stops? Above highs, below lows. Smart money needs to trigger those stops to grab enough liquidity to fill their massive positions before they send the price screaming in the other direction. Your job is to spot these zones and get ready for the hunt.
Okay, so we've mapped the battlefield, we've identified our target, which is the liquidity. Now we get to the next phase, patiently waiting for the signal that smart money has sprung its trap.
And this is the 1-2 punch that signals the ambush is on. First, you have to see a clean liquidity sweep. That's where price pokes beyond a key high or low, takes out all the stops, and then rejects aggressively back inside the range. That's immediately followed by a change of character, or shotch, which confirms that the reversal is for real.
And you know, the source material is super direct about this. It's a brutal but honest way to look at it. For this kind of high probability setup to even exist, other traders have to be trapped on the wrong side of the market first. That sweep is the event that creates the opportunity.
Now that chalk, that is your non-negotiable confirmation. It's a clear break of the little bit of structure that created the sweep. And, as it says right here, it has to be a candle body closing past that level, not just a wick. Think of it like this. A wick is indecision. A body closure, that's a statement. It tells you the big money behind that liquidity grab was strong enough to definitively shift the market's internal momentum.
All right, now we get to the absolute heart of the model. And folks, this is the part we're really going to focus on today because it requires the most precision, selecting your entry zone. This is where you pinpoint the exact area to stage your entry from.
And let's be crystal clear about this. According to the source material, this is the make or break step. Seriously, a sniper doesn't just shoot in a general direction. They have a precise target. Your ability to correctly identify the right, high-probability zone is what separates a profitable trade from just another frustrating loss.
So what are we looking for? It's called a fair value gap, or an FVG. Just look at the 3-candle pattern right here. You've got candle 1, then this big impulse candle in the middle, and then candle 3. See how the wick of candle 1 and the wick of candle 3 don't overlap at all? That little space in between? That is the FVG.
It represents an inefficiency, an imbalance. It's basically a footprint telling us that institutions pushed price so hard and so fast that the market couldn't keep up. And that gap, well, it acts like a magnet for price to return to later on.
Now this slide right here, this is your final filter. It is a non-negotiable checklist for an A+ setup. Let's run through it. 1. A liquidity sweep just happened. Check. 2. There's strong displacement, a powerful energetic move away from that level. 3. That move left behind the fair value gap we just talked about. 4. The whole thing caused that change of character. And 5. The zone is located in the correct premium or discount area. If even one of these rules is missing, the source is clear. You skip the trade. No exceptions, no excuses.
Okay, so once you've found that A+ zone, the one that ticks all 5 of those boxes, it's finally time to plan the execution. And this is where patience and precision become everything.
This table lays out the plan perfectly. Your trigger to enter is price coming back to that fair value gap you found. You do not chase it. Your stop loss? That goes safely on the other side of the wick that created the initial liquidity sweep. And your targets are just logical points of liquidity you can see on the chart.
And I know we keep saying it, but this is a point the strategy just drills home again and again. Patience is your greatest weapon. The entire model is built around letting the market do the work and come to you. That amazing reward to risk potential comes from waiting for that super precise return to the imbalance, not from getting scared and jumping in early.
You know, a perfect model is completely and totally useless without the mental strength to actually follow the rules. And that brings us to our final, and you could argue most important section, the mindset and the discipline that truly separates the pros from the amateurs.
The source material gives us a super clear do not list. And honestly, just avoiding these common mistakes like trading without a liquidity sweep, ignoring your higher timeframe bias, or trying to force a setup that just isn't there, that alone will put you way ahead of the crowd. This is your defense against self-sabotage.
And here it is, the golden rule of survival in this game: risk management. The source is absolutely adamant about risking a very small, predefined amount on any single trade, suggesting just 0.5% of your account. This is what ensures that no single loss can ever knock you out of the game, which allows you to stick around long enough for your edge to actually play out. So at the end of the day, you have the blueprint. We've just walked through the entire rules-based, high-probability model from start to finish. All the mechanical steps are right here. The final variable, the one thing that can't be taught on a slide, is you. You have the model. The only question left is, do you have the discipline to execute it?